Welcome to the latest episode of Damien's Midweek Markets, the show where I talk about everything that's going on in investment markets. So yet again, we've gone 1 week on from the last show, and what a week it's been. So last week, we talked about the currency war, the winners and the losers, the retaliation by China against Donald Trump's plans to impose new tariffs on Chinese imports. We've gone 1 week on, and we've had yet again another wobble, U-turn, whatever you want to call it. Donald Trump has decided to waive or postpone some of the tariffs until December the 15th on certain goods that come from China. Now, those sorts of goods are things like mobile phones, laptops, games consoles, computers, and footwear, clothing, all the things that US consumers will want to buy for the holiday season. Now, this is interesting because Donald Trump has been well known for claiming that tariffs are actually paid by China and not US consumers. Now, that is despite the fact that the truth is that US consumers end up paying for them, because when you import goods from overseas and you apply tariffs to those goods, then inevitably you will pay more. And the problem with that is inflationary. So that means that if the price of goods that you're importing go up, they cost the consumer more. That's inflation as prices go up. And that's not a good thing for the US economy. Now, Donald Trump, as I mentioned last week, really wants Jerome Powell and the US Federal Reserve to cut interest rates. The problem is, if you cut interest rates, that tends to fan the flames of inflation. So if Donald Trump is doing that himself with his tactics on the trade war with China, then that means the likelihood that Powell starts to cut interest rates probably reduces. So maybe Trump has finally admitted, if not publicly, but by his own actions, that in fact US consumers do really pay the tariffs on these goods that they're importing, and that he's having a detrimental impact on the economy. And so some people are suggesting that his actions now postponing some of the tariffs until December is twofold: to help US consumers, so therefore on holiday spending that still occurs and still is a boost to the US economy, but also so he's not backing Jerome Powell into a corner so he can't cut interest rates. So it's an interesting dynamic. So what did that mean for investment markets? We saw investment markets bounce by 1.5% on the day. That's a big leap. We saw the VIX drop still above that key 15 level. That 15 level is a level whereby if we're above that, it's generally slightly negative for the outlook on stock markets. If it's below 15, then it's seen as a positive. But we're still up around 20, and that is a long-term average, so it's nothing untoward. But with the stock market bouncing higher, some people were hoping there'd be a follow-through. After all, there was some positive news that maybe US trade relations with China were starting to improve with Trump's latest actions. But interestingly, since we've had a spike in volatility back in 2018, if you go back and look at that chart, you'll see that volatility has been picking up over time. Since then, we've not seen a back-to-back day where we've had the S&P 500 or the Dow Jones for that matter rise by 1.5% one day and be followed by a similar move the next day. What we're tending to see is markets pull back or not necessarily continue to rally. So what have we seen? As I make this video now, markets already, the futures that is on US markets, are pointing to a lower open. So it doesn't look like we're going to get that follow through. So we're following a similar pattern. Now, for the tech car crash I mentioned last week, of course, anything that's positive for US trade relations with China is going to be positive for Apple. So Apple's share price bounced 4% on the day. So that's always going to be supportive for US stock markets. But if we look at what bond markets did, bond markets weren't as convinced. We did see the yields start to lengthen. We saw them start to rally. So that is a sign that people are starting to sell bonds. But it wasn't a wild move. It was a move that was slightly tentative. Of course, we're still seeing China devalue its currency. It seems to be last week's story. People are still watching the yuan and the US dollar exchange rate. So we're still above that 7 level. So there's still a lot of caution. But one of the things that's really starting to grip markets is recessionary indicators. Now, last week I mentioned about the possibility that we might have a recession. We're in this world where it's very much like Game of Thrones. Winter is coming. That's what the indicators seem to be suggesting. Now, we talk about yield curve inversions, and that is typically talking about the 10-year yield versus the 3-month yield. So when we have treasuries, for example, the US Treasury yield is normally lower if you are lending money to the government at a shorter time frame, so let's say 3 months, than it is if you're lending to the government for 10 years. And that's because there's more risk if you lend to a government for longer. So you'd expect the yield on a 10-year note to be higher than you get on a 3-month note. But of course, we had an inversion of that part of the curve in May. What we're seeing now is the 2-year versus the 10-year invert. So you're getting paid more yield on a 2-year note than you are on a 10-year note. And that is a dynamic. That 2-year versus 10-year is one that's more perhaps closely watched by most investors than the 3-month versus 10. The point is that the yield curve is starting to invert even more, and people are becoming more aware of it. So investors who were largely ignoring it are starting to be very conscious of these recessionary indicators. So that 2-year versus 10-year inversion happened in the US today, and it happened in the UK. Alarm bells are definitely ringing. That doesn't mean recession or winter is definitely coming, but it's been a fairly reliable indicator of recession possibly in the next 12 months in the past. Now, if you couple that with the news that in Germany, the second quarter GDP figures which came in showed that the German economy had contracted, then that's obviously a negative sign, because if you get 2 quarters of negative GDP, that is technically a recession. And of course, we also had the same news with the UK. The UK GDP figures were negative for the second quarter of 2019 as well. The UK economy contracted by 0.2%. That caught people by surprise. So because economic indicators, GDP numbers, were always backward looking, so they're not released until we're out of that quarter, we could very well already be in a recession in the UK. It's not guaranteed, but if this quarter turns out to be contracting, and don't forget we're heading towards a possible no Brexit scenario, then we could already be in a recession. We just won't know about it till the end of the year. So I think that has caused markets to start to very much focus on that. Now, despite the trade war potential thawing, commodity markets are also showing some alarming signs, and they're suggesting that perhaps the US trade deal isn't thawing as much as the headlines would like you to believe, but also the economic damage has already been done. Now, 80/20 investor members will see this week there's a whole newsletter dedicated to a particular commodity, which is a very good indicator for economic stability and health globally, but also for the trade war progress, the trade war truce, and the likelihood of one. It's one you should watch closely, because particularly it's been a fairly good indicator of stock market wobbles in the future. So make sure you check that out. If you're not already a subscriber, then do take out the free trial. So the final thing I just want to mention this week is, of course, the pound. Now, the pound has started to inch its way lower than the $1.21 level that we've had in recent weeks, which seemed to be a bit of a floor. Now, this is a low that has been a low we've not really seen since that Brexit referendum over 3 years ago. Now, we're at such a low level, we're going to have to see if we're going to break below that. If we do, then where could the pound end up? Could it be parity against the dollar, like some people have claimed where it could go? That would be quite extreme. But with the bad news already priced into the pound versus the dollar and against other currencies, this could have a huge impact on investor returns going forward. So keep an eye on that pound versus dollar exchange level. Of course, if everything becomes rosy, we get a deal which seems unlikely with the European Union, then things could rally. And of course, don't forget to check out this weekend's podcast, where I do a whole special on a Brexit playbook when it comes to investing. I talk about the assets of what they might do, ones which might go up and ones which might go down in the event of a no-deal Brexit. So make sure you check that out. That's out on Sunday morning. So that is it for this week. Just to bear in mind, there won't be a midweek market show next week, as I am taking a well-earned rest for 1 week. We'll be back the week after the bank holiday weekend. As usual, you can contact me at Damien@moneytothemasses.com. That's the email address, and via Twitter, which is moneytothemasses with the number 2. So until next week.